Ups and downs on Wall Street this week set off alarms in the media and led to more scrutiny on the stock market. The first significant dip came at the end of the trading week on February 2nd, and another steep drop kicked off this week. Chris Lamoureux, a finance professor at the U of A Eller College, told us how volatility this week fits into a bigger picture when it comes to investing.
Volatility in the market often is not associated with any volatility or concerns about the underlying economy. And so therefore, there's no reason to look at the recent stock market volatility and fear that that is indicative that something is wrong in the economy.
Volatility came into play when the stock market plunged for 2 consecutive trading days. The Dow Jones Industrial Average dropped more than 1,100 points on Monday. Lamoureux says it's important to put those losses into context.
So effectively, the 2-day drop from Friday and Monday erased about 6 weeks worth of gains from early December through the month of January, or perhaps actually what was more surprising. January of 2018 is an unusually strong month. The market was up over 6%. Professionals are aware that this fast run-up from December and January was probably something that was going to, at the very least, bring about some incremental volatility to markets.
My 401k retirement plan, should I be concerned at this point?
You never want to react to significant swings, either on the upside or the downside, in terms of your own personal financial planning. What you want to do is have a plan in place that is consistent with your goals in terms of retirement and your lifestyle, etc., and stick to that plan over time. You don't want to respond. People who, for example, saw the stock market running up over the last couple of months and decided to shift money in, those people are paying a price now.
What just occurred, as you said, can tell us something about the future. So what's about to happen?
Well, one thing we know has already happened, and that is that interest rates have started to rise. So an investor looking, do I invest in the stock market or do I invest in other types of securities, now has some real choices to make. 5 years ago, no one would have put their money into a treasury bill earning 1/20th of 1%. That was not a real attractive alternative. There's some indication in last week's job report that wages may be starting to rise. That often induces increased inflationary concerns. And so that will result ultimately in higher interest rates. That makes fixed income investments, such as bonds, relatively more attractive. And so it's not surprising, perhaps, that we see some heightened volatility.